Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back, everyone, to another edition of All Things Financial. What I wanted to go over, a little bit of a continuation on what we've talked about over the past couple weeks, is this proposed tax plan, the Trump tax reform plan. What initial proposition is being made where we need to figure out what's happening in year-end 2017 and what might happen in really 2018. We have a situation now where we might have tax deductions that are being lost. We might actually lose. We keep standard deductions under the proposal, but we might actually lose the itemized deductions. That's huge, especially if we lose itemized deductions on property taxes and things like that. So I wanted to bring out in today's show a little bit of a summary snapshot of the initial changes that are proposed. We all know what's proposed is not normally ending up as the final revision or what's passed. We know that. And we're in a situation now, year end, of trying to figure out 2017 and whether we can go back and amend 2016 if you had done any IRA conversions to a Roth and wanted to recharacterize those back. And all of those issues come up this month in October, November, December. So most times 2016, long gone, closed, are very rare opportunities that we can ever go back that far. But in the current year, 2017, now we have enormous tax planning opportunities because it looks like we might have a tax change in 2018. So do we take advantage of and capitalize on our current rules, or do we just slough this off, this tax reform proposition, because it'll go nowhere and our taxes will be the same in 18 and 19? Well, that's the big discussion. So number one, I wanted to refresh everyone listening and watching on some of the advantages we have under today's tax code you might not be taking advantage of, and you may want to consider between now and the end of the year putting attention onto. For example, I've talked about this in shows before, but we have capital gains tax rates that are probably the most favorable I've ever seen. The capital gains tax means if you own any asset, stocks, real estate, something like that, what's considered a capital asset, and you bought that asset at X price and it's now worth more, or it's now worth less, and you sell that capital asset either for a loss or for a gain, that's considered for tax purposes in most cases a capital gain or a capital loss. There are a couple of assets we can't take those on, but most, like stocks and real estate, we can. So here's some opportunity. And I'll go through this in a little more detail, but anybody in a 15% income tax bracket today and then sells a capital asset, let's say you profit $10,000 on a stock that you sell, that is a capital gain. And a lot of times near year end, people will say, I don't want to sell a stock and take the $10,000 gain. And I say, have you looked at your tax return and do you know what tax bracket you're in? Of course, nobody really looks at that too much. And we do. And we say, if you're in a 15% tax bracket and you have a $10,000 capital gain, we can help you calculate to see if that $10,000 gain keeps you in the 15% tax bracket even though you will owe tax on it if it keeps you in the 15% tax bracket. Now, here's why we do that. The client's saying, wait a minute, I just said I don't want to pay any more income tax, even if it doesn't throw me into the next bracket. And we say, hold on to your hat. If you stay in the 15% bracket, even after you sell that stock, that gain is characterized as a capital gain. And if you've held that stock for longer than a year, it's characterized as a long-term capital gain. And if that is the case under today's tax code, which maybe we'll lose under this tax reform, we don't know yet. But under today's law, we do know what we have. Capital gains tax rate for anyone in the ordinary income tax rate tax bracket of 15%, the capital gains tax rate is 0. So as long as that amount of gain doesn't throw you into a higher bracket, we tell the client, have no fear. When you take that $10,000 gain and it's a long-term capital gain, you may have the potential of getting out of it and owe 0 income tax on that $10,000 capital gain. Seems like magic, right? I've said this on other shows for the last couple of years, and most people aren't taking advantage of this. Now, we have long-term capital losses, we have short-term capital losses, we have long-term capital gains, and we have short-term capital gains. There are strategies we employ, and especially near year-end. So we're in the fourth quarter, and now we get our thinking caps on and we do our analysis. We actually do a pro forma tax return, and we say, how does this tax year look if we change nothing? It's just going to run through the end of the year. And then we look and say, what can we do proactively to change the tax return? What if we take income we weren't planning on taking? What if we defer income? What if we prepay taxes for 2000 or expenses that are deductible or charitable contributions for the next year in the last month of this year? In other words, accelerate expenses. Doesn't that make sense? Or defer income. Or sometimes we want to accelerate income. So there are strategies here near year end. Well, now it's been compounded because we have a reform proposed that's going to take some opportunities, planning opportunities away from us. And I want to share some of those with you. So here goes. We have some guidelines that come through and resources available. So I want to share with you some of the proposed changes, and you can evaluate in your own individual circumstances, or we can help you do so, how these changes might impact you if they go through. So the first one, tax reform. What we're looking for, first, new tax rates. We currently have 7 different tax brackets. The proposal is for whittling that down to 3 tax brackets, 15%, 25%, and 35%. Now, the proposal allows for possibly one more, but they haven't defined it yet, so it's up for debate. So right now we have 3 tax brackets proposed for tax simplification, 15, 25, and 35%. Okay, there's some tax planning opportunity. Once the proposed reform defines what income will fall into each of these brackets, it has not been determined yet. So it's hard for us to plan, will this be better for you or worse for you? Should we take more income now or less? And let me share with you what I mean by that. Let's say one of you inherits an IRA from somebody. This year, 2016, you received it, and this year, 2017, you have to take a required minimum distribution. Let me just give you an example. You have an ordinary income. Let's say your income's $40,000 a year. That's what you use to live on, and you take that as your pay. That's your W-2 income. And let's say you have a 401k at work, and you defer 1% of your pay every year. Maybe the company matches it, maybe it doesn't. Whatever you defer in a 401k, you do not have to pay income tax on that amount of pay because you deferred that contribution into a 401k. That's the equivalence of a tax-deductible contribution. Just the same as if you made a tax-deductible contribution into an IRA, which don't forget, by the way, you can do up to $5,500 tax-deductible contribution for you, another $5,500 tax-deductible contribution into an IRA for your spouse, and that's a traditional IRA. In addition, if you're over age 50, that changes to $6,500 for each of you, and that amount of income is reduced on your income tax return. It's pulled off of the return. You don't owe income tax on that. All right, let's talk about something. Back to my example on how you can strategically sometimes structure income. It's near year end. This year, you have tax planning opportunity on inheritance you might have received last year that you might have been the beneficiary of an IRA. Because it was a stretch or beneficiary IRA designation that you chose rather than cashing it out, or if you did cash it out, in either case, starting at least now, the year after you inherited that IRA, you're required to take a minimum required distribution no later than December 31st of the year following the year you got the inheritance, which would be this year if you inherited it last year in my example. So let's say you inherited a $100,000 IRA and you don't have to pay tax on it, you didn't cash it out last year, but now it's a stretch IRA by your designation, and this year you have to take a minimum required distribution. If that is the case, depending on your age, if you're 65 and it was your 90-year-old mother, let's say, whose IRA you inherited, and you're 65, you may say, or 62 or 60, let's say, for example, while you're still working, you could say, I don't want that extra income. Is this going to force extra income on me because I inherited that IRA? And the answer is yes, it is. At what rate? It might be about 3%, maybe 4%, but it's usually around 3% based on life expectancy, what you might have to draw from that $100,000 IRA. So that means an additional $3,000 of ordinary income is being thrust upon you and on your tax return before the end of this year for that inheritance, money you don't need. So here's a simple solution. Why not up your contribution to a 401k at work or a contribution to an IRA of that same exact amount from your pay? In other words, if you have to take an additional $3,000 income because of an IRA inheritance and the required minimum distribution, why not just reduce your other income by that same amount and not pay tax? In other words, reduce it. You're still living on the same amount of money. You're just dumping an extra $3,000 contribution into your work 401k, which might also have an additional benefit of the employer matching that contribution. So now for you having to receive $3,000 from an IRA inheritance, you might be able to contribute an additional $3,000 into your 401k, and it costs you really nothing. You're reducing your taxes so you're not paying double, and maybe you even get an employer match, which means you just instantaneously doubled your money by employing that. Those are the kinds of strategies that are available. I don't expect you to learn all these. I expect you to understand, hey, wait a minute, there's a lot more to making the most out of my money than I realized. You can give us a call. We'll do tax efficiency analysis for you. That's what this is. And structure. Everybody's situation is unique and different, but there are usually tax opportunities that people are missing and they just go past and they never take advantage of. So now that we have tax reform, that actually accelerates our need to do year-end tax planning. And that's just one example. Now, back to this tax reform. We have 3 brackets, 15, 25, and 35 that are proposed. Now, owners of pass-through entities, companies like Subchapter S corporations, There's a new top rate of 25% being proposed. Now, normally when we're in a pass-through entity, for all you individual business owners, all you independent subchapter S corporations, things like that, we get a pass-through of whatever income flows through the company, whatever profits are left over, we're taxed on our individual rate. Might be 15%, it might be 33%, it might be 39.6%. We might be subject to the Medicare 3.8% tax. Hey, all of us are different. But the key is our tax rates could be higher than 25%. So the new tax reform is saying the top rate for flow-through business entities are 25%. Now, Congress is all up in arms over this one already, saying, wait a minute, the wealthy, why won't they just, if they're earning personal income and high personal income, $400,000, $500,000, $600,000 a year, why won't they just form subchapter S corporations to draw that income from and lower their tax rate? So they're all up in arms about that, saying they'll, a lot of the rich will abuse the system and form corporations, flow through corporations, and they probably would. So expect this to be modified and adjusted to try to help avoid some of this taking advantage or exploiting of these rules. But the basic rules right now are, for any of you with a subchapter S or LLC taxed as a subchapter S, any flow-through corporation, be aware of this potential change and see right now if it's to your benefit to defer income out of this year in case this proposal passes. Now, the 20% corporate rate is also proposed. Now that's big. Most corporations pay tax at a higher rate than that same amount of income would be taxed at an individual rate. So it's almost like a corporate penalty tax. Well, now this new proposal is saying a 20% corporate rate being proposed. And that's basically saying, really, when you look at that, companies may get a favorable tax rate. That could help businesses a lot, and that's their intention. So watch for that one. That is proposed in this. A big one that affects a lot of people or is in interest to a lot of people is repeal of the estate tax. This Tax Reform Act is not passed. It's just a proposal. Does have in its terminology to repeal the estate tax. The federal estate tax is a tax upon death that's imposed on estates that exceed $5.49 million in value per person. So if you're married, if you do it right, you as one of the spouses are exempt up to $5.49 million of your assets are not subject to federal estate tax. And for those of you as a married couple whose assets exceed that amount, the other spouse also enjoys that same benefit. So sometimes what we do, we go to the attorneys and look and say, should we identify if I have a $10 million estate? $5 million is mine, $5 million is my spouse's. Try to identify that or preserve the marital exemption that says we get to transfer everything unlimited for estate taxes anyway. We could have a $25 million estate, and if one spouse dies, the other doesn't pay tax anyway, but we lose the individual exemption. So there are strategies involved there. Well, what about for all the rest of us who don't have a $5 million estate? Then don't worry about the estate tax because it won't affect you. And that's today's law. This proposal says they want to abolish the federal estate tax entirely for all levels of estates. So it'll only affect the rich. And that's one of the complaints about the tax reform. Hey, wait a minute, some of these proposals might only be benefiting the rich. So they go through this. Well, I'm going to tell you about another one that we talked about before in prior shows. Right now, for all the rest of us who you look at your total assets and you say, we're under the $5 million, let's say. We're not subject to the federal estate tax. And then we get to the federal income tax question. If something happens to us, do our heirs owe income tax on any of our assets? Wow, what a question. We don't owe federal estate tax if we're under 5.49 million, or almost 11 million if we're married. But wow, we might be hammered on federal income tax. Here's why. We have life insurance. Well, guess what? Life insurance is not traditionally income taxable. So we're safe there usually if it's made payable to an individual beneficiary. But what about those IRAs? Ouch. They're all fully taxable. Now, they might be tax deferred if you inherited IRA as a stretch IRA or stretch or beneficiary IRA designation. And you could stretch out those taxes over your whole life expectancy. But it's still fully taxed, just not all now. What about annuities, tax-deferred annuities that are not in IRAs that were purchased for X price and now are worth Y price? That, for example, might mean I put $100,000 into annuities when we purchased them. They're now worth $400,000, tax-deferred gains all over these time frames that they've just been allowed to grow and grow and grow. I have a $300,000 potential gain. When I die, that annuity, not being in an IRA, cannot be inherited intact usually. And even if it could, it's typically entirely taxable, all up front, all now, at the time of death, unless the beneficiary chooses to annuitize it over their life expectancy and give up use of the money in exchange for a lifetime monthly or annual income, which is many times a very risky thing to do. Otherwise, they'll most likely be fully taxed on all those gains as ordinary income. So no matter what the size of your estate, you have something like annuities, tax-deferred annuities, we're looking at ordinary income and high taxes spiking for the 1 year in the year of inheritance. So again, we go back to, wait a minute, we need to, maybe reduce income from other areas because we can live off that money for right now if we're going to be taxed on it anyway. Maybe we should max out the 401k, which we would never usually do, and things like that to reduce income everywhere else or eliminate taking income from our normal sources just for 1 year and not be taxed over there too. Okay, so back to this estate tax. We're not worried about the estate tax now, but we talk back about this income tax. Let's say we have these capital assets and then we die with these capital assets. Is an annuity considered a capital asset? Typically, no. That is ordinary income asset. Capital asset would be, what about our investment property and what about our stocks? So if I have annuities, they're taxed as ordinary income typically on the gains. If I have stocks, they're taxed as capital gains typically. Well, they are treated entirely differently at death. I already explained to you the nightmare on the annuities. That doesn't make annuities bad at all. It just makes it a different animal than stocks, let's say. So stocks, I put $100,000 into stocks in the same example. They'd grow to $400,000 over the length of time. I never sold the stock. We still hold the stock. We pass away. Our heirs inherit $400,000 value in stock, and the cost basis is $100,000. There's a $300,000 gain, just as in the annuity. Here's the difference. Today's tax code has what's called a step up in basis provision, which says the heirs only have to pay tax on the amount of value that exceeds the basis, their cost. So in the annuity, the cost is $100,000 in my example. The value is $400,000. They have to pay tax on the $300,000. On the stock, because it's a capital asset, we get a step up in basis in today's tax code that says the heirs inherit that stock, but their basis, because they're an heir now, is the date of value of the stock, the date of death they received it. So it's no longer $100,000 and they owe tax on the $300,000 gain in the stock. Their basis, the heir, who inherited the stock instantaneously, is the full value of the stock the date of death. So the heir says, hey, IRS, I inherited this annuity. How much tax do I owe? Versus I inherited this stock. How much tax do I owe? And the IRS says, well, if it's a stock, you don't owe any on the $300,000 gain because of a step up in basis that you receive. And on the annuity, you owe tax on $300,000. A little bit of a difference there, right? So they'll call that a snowball effect or a tax time bomb, some people say, on the annuities. And again, that doesn't make them wrong or right. It means for taxes, you want to identify the differences in your tax planning. That's what that means. We don't make investment decisions based on taxes, but we also don't make investment decisions ignoring or ignorant of tax consequences. Now, in other cases, somebody will say there are different ramifications and we need to do our tax analysis. Before we make any decisions, we need to also incorporate tax analysis. That is typically advised, where we don't just make decisions based on one component, we analyze all of the components. So we're near year end. You need to be aware of these rules as they stand right now, because our big question was, if we lose the estate tax, are we going to lose this step up in basis rule? Right? Because that's been talked about. It's been talked about if we repeal federal estate tax, Congress says, if we repeal federal estate tax, we're also going to repeal the step up in gains benefit. Well, that would hurt everybody at every level. But from what we see in this proposal so far, I'm here to say there's some comfort in the initial proposal seems to be indicating that they will preserve or want to preserve, unless it's kicked out or doesn't get approved, the step up in basis benefit. So it looks like we may get both based on how they initially proposed this. All right, we're out of time for today. This is All Things Financial. I appreciate your tuning in. I'm going to come back next week with more on this tax reform, the proposed tax reform, so you could do a little better refined year-end tax planning than we're usually able to do, taking advantage of this year versus next year, what might come to play. So next week, I'll come back with some more on what to expect out of this tax reform or how it's initially proposed. Thanks again. Hope you tune in next week. I'll be back again.